We have often spoken to CIOs of mutual funds to understand where they see things going, how they're seeing the moving parts in the current landscape. And we've got Srinivas Rao Ravuri, who's the CIO of Equities at PGIM India Mutual Fund, joining in. Thank you so much, Srinivas, for joining in, for taking the time. I want to start by asking about the prevailing scenario. You've seen bond yields rise globally in the recent past. You've seen a significant amount of churn in the capital flows. Foreign institutional investors have been selling in emerging markets, and specifically ours, and consistently. Which of these moving parts are you as a fund house focusing on the most, and what, according to you, is what you should watch very closely?
Alex, the most important thing is the earnings growth, corporate earnings growth. So I think that is clearly in our favor. I think we are looking at about 30% kind of earnings growth for the current financial year ending March 22. And next year, the street estimates are about 17 to 18% earnings growth. So I think that's one thing which is clearly in favor of markets. Having said that, I think we are on overall markets, we are clearly cautiously optimistic. I think last 18 months have been fantastic for markets, and investors who stayed invested or who put in more money into the markets. As you can see from the data, I think there are quite a few new investors who entered into markets in this lockdown era, and all of them are sitting on fantastic returns. And I think there is also that positive bias that is driving markets today. In the sense, so new investors who ventured into markets, their initial experience has been very positive, so that makes them more positive. And I think that's one reason why we continue to see a very strong inflows into mutual funds, and also very strong retail participation in the stock markets. However, I think there are clearly excesses in certain pockets. And after delivering very healthy returns in calendar year 2020 and 2021, I think investors should definitely moderate their return expectations in the current calendar year, Alex.
All right, Srini. Now, you spoke about corporate earnings, and you said that this is a significant tailwind. You've also pointed out in the note that you released recently that it's important to have a stock picking approach, a bottom-up approach. Which pockets, according to you, are showing the most opportunity?
So Alex, overall, when you're looking at, I think, sectors, as you also mentioned, as we keep saying, we are not buying nifty, nor are we buying sectors. We are buying end of the day companies. So our stock selection investment process is clearly bottom up approach. So we are buying individual stocks. But if one was to look at broadly where we are seeing tailwinds, or there is still risk reward is in our favor, and where it is a bit challenging, Alex, I would say we are still positive on sectors like software industry, we are positive on healthcare, and we are positive on capital goods or industrials. And these are the three sectors where we are positive and overweight in our positions versus the benchmarks. Clearly, IT sector, I think the initial results are out, is a huge beneficiary of this digitization trend that we are seeing. In the past, global companies used to insist that someone who is offering them a solution should have an on-site presence. Whereas, thanks to COVID, now Indian IT companies are keeping their employees in India and still able to offer the solution. So as a result, we are actually seeing margin expansion as well, in addition to very strong demand. So I think that seems to be a secular growth story for Indian IT sectors. That's the reason why we are positive. And here, I would say the large caps are relatively less expensive versus some of the mid cap names. So we are more positive on the large cap IT names.
Okay, I get that point. It's interesting. One of the sectors that you very conspicuously missed out, that is missing from that list that you pointed out where opportunity is prevalent, is the financial sector. Why is that?
So, Alex, if you see the financials weight in the respective benchmarks is fairly high. In Nifty, it is about 33%. In BSE 200, it's about closer to 30%. So it is the largest weight in terms of sectoral exposure. And when you compare with that, most of our funds are underweight versus the benchmark weights. So our thought process is in the past, actually, if you see, PGIM has done extremely well in the last 2 years in terms of performance, and also, the same is getting reflected in our fastest growing assets. What has helped us is this underweight position in financials. We think that financials are a play on economy. In the past, we've seen economy consolidating and growth rates being lower. I think finally that phase is over. Also, the concerns about the um, uh, assets or NPAs, I think that cycle is also getting over now. I think these two are clearly behind us. I think growth is very much visible, and I think even the NPA cycle is also clearly behind us. But I think the new concern has emerged, Alex. That's the beauty of stock markets. We'll always have it's a dynamic situation. The new situation is what is the impact that traditional financial companies will have from the onset of new fintech companies or the disruption that we are seeing in certain areas. I think one has to still wait and watch on the likely impact of fintechs on the traditional banking or financial companies. And that's the reason why we are still having a relatively underweight positions on the financial side.
Right, Srini, that is a valid justification on financials. Let's talk about your stock selection process, though. And even the large cap IT companies that we spoke about, they've gained significantly over the last couple of years. Aren't valuations a bit of a concern at this point?
Alex, I've already mentioned that overall one should tone down return expectations. So the significant returns from overall equity investing as we head into the current calendar year is very, very unlikely. So one has to tone down expectations. I would say same applies to IT sector as well, or including the large cap names that where we have invested or where we are overweight. So we are not trying to play, further value re-rating here. We are saying that earnings growth seems to be fairly strong, and if we can maintain these valuations, so even then, I think these companies would give us a healthy returns. Alex, please remember these companies are very well governed, large, liquid, very strong balance sheets, and pretty decent payouts. So when we are looking at a risk reward perspective, I think there is still clear opportunity in these large companies versus, I would say, many other sectors in the market.
Let's talk about the philosophy that PGIM India follows. What is the guiding principle or philosophy that governs your equity investments?
Sure, Alex. So our investment philosophy is GARP, as we call it, growth at reasonable price. So investing into equities is all about investing for growth. So you have to invest in companies that deliver growth. So that's a very important thing. At the same time, Alex, it is very important to know what price are you paying for that growth. So when you are investing into a company, you are looking at what the company's business is about, what is the outlook for the business, how is the management, and also important is what is the price that you are paying. So that's where we are saying that growth is reasonable pricing. The reason why I'm mentioning this is we have seen in certain cases companies are great, businesses are great, but I think valuations are clearly not on our side. We've seen in the past some of the great companies have not delivered any returns for almost 10 years. So I think it is equally important to focus on what is the price you are paying, in addition to just instead of looking at only at the business. So our underlying philosophy is that we will invest in companies that will give us good growth, but we will not invest in companies where we think the valuations are expensive. I think that is what is helping us to deliver what the kind of performance we are delivering, Alex.
All right, Srini, thanks so much for joining in, for taking the time. I'm
Thank
sure
you
my
for the
viewers and
opportunity,
your
Alex.
investors are that much clearer about the philosophy that you follow now.